Hello, my name's Andy Critchlow. I'm Head of News at S&P Global Commodity Insights. And welcome to the Look Forward podcast from S&P Global. In today's rapidly shifting markets, success depends on anticipating what's next. The professionals who excel are those who can spot emerging trends before they fully materialize. The Look Forward podcast delivers exactly that. Insights to help you prepare for tomorrow's opportunities and challenges. We bring you expert perspectives on macroeconomic trends, capital markets, energy transition, and global trade, with a sharp focus on what these developments mean for the decisions that will shape your tomorrow. This podcast connects you with S&P Global's Look Forward Council, bringing cutting-edge research on long-term trends and transformative market shifts. Together, we're committed to providing the forward-looking intelligence you need to navigate uncertainty with confidence. I'm joined today on today's podcast by Paul Gruenwald, Global Chief Economist at S&P Global, someone who I first actually interviewed back in 2010 in Sydney. Paul probably doesn't remember that too much. I was a reporter then at the Wall Street Journal. It's great to have Paul with us today, talking about some of the big issues facing the global economy, central banks, their independence, the future of the dollar, the scorecard economically of the U.S. administration and President Donald Trump, and what to look forward to for the rest of 2025. Paul, to kick things off, the not so insignificant subject of central bank independence has been thrown into the spotlight recently, certainly by some of the comments that President Trump has made with regards to the Fed and Jerome Powell. How do you see this playing out?
Yeah, first, Andy, it's good to see you again, and happy to be on the podcast. Well, this is obviously a very critical issue. The way we economists think about it is central bank independence is a good thing. The central bank's not independent of the government. It's within the government, but it has kind of operational independence. So to use the Fed as an example, the Fed has a dual mandate, which is low and stable inflation of 2% and also full or maximum employment. And the Fed adjusts the Fed funds rate in order to achieve that objective. The issue we've seen in several countries over the recent past is that when the central bank is not independent and it's kind of under the thumb of the government, it tends to overstimulate the economy. The government obviously wants to be popular, and that leads to inflation, and that leads to macro instabilities. So as a profession of economists and also the markets, and most people generally came to the view a few decades ago that central bank independence is a good thing. So most governments, again, want to kind of juice up the economy and have easy monetary policy, but having the central bank have that operational independence to try to achieve its goals, we think that's a good thing.
Yeah, because, if you go back to, say, the UK in the 1970s, early 80s, that inflationary story, central bank in the form of the Bank of England that was definitely being led by its political paymasters, didn't lead to the outcomes that, economically, certainly in terms of inflation, probably that people were looking for. What do you think is driving, though, this philosophical and an actual pressure now that's being exerted on central banks? Is this kind of just a function of politics becoming more fractious, or is there something else at play? Because actually, the economic conditions globally are, they're pretty good at the moment.
Yeah, well, I mean, the global economy softened a bit, but we're certainly not in a bad spot. To take the U.S., we've got the economy slowing. We're not even in the recession camp for our baseline. But I think it's kind of baked in to the process. Again, governments want to look good, they want to be popular, and if you've got a strong economy with lots of job creation, that's a good thing. But the problem is kind of this dynamic consistency. We can juice up the economy a bit today, but that's going to push inflation up in the future, and inflation expectations could become unanchored, and then it's very difficult to kind of re-anchor them and restore stability. So, political noise or temperature goes up and down. We're in a period right now where the temperature is rather high, so we're seeing a lot of pressure in the U.S. Kind of against the central bank, and we've had this debate before.
Because those inflationary fears, certainly the Fed has been cautious on rates, but those inflationary fears that we really did worry about back in, say, 2022, Russian invasion of Ukraine. You had a big kind of spike in commodity prices as a consequence of that, and obviously a feed through into inflation rates globally. But that's sort of dissipated. I mean, where do you see inflation, not just in the US going, but globally over the next year?
Well, if you think back to 2022, that was a big surprise, right? We hadn't seen inflation at those rates since the 1970s. And to be honest, central banks had spent the previous 2 decades trying to get inflation up rather than get inflation down. And we had the combination of some of the shocks, supply shocks from the pandemic and overly loose fiscal policy in many countries. And we had that burst of inflation. That has been, that's been kind of put under control. We had the steep rise in policy rates, but most central banks are at or near their target. The ECB, in our view, is done, for example, cutting rates. But that was a bit of an embarrassment for central banks, and their credibility is very important to them. They want to make sure inflation expectations are anchored over the medium term. That's the way they measure their credibility. So I think the cuts have been cautious. We did see a 50 from the Fed, and I think we saw 50 from the Bank of Canada. But most central banks have been going by 25 basis points, cutting rates since the middle of last year. And again, we're getting inflation close to target, although the tariffs are going to complicate the picture a bit in the U.S.
That's a great segue onto the subject of tariffs. Considering the kind of shockwaves that tariffs delivered, certainly to stock markets back in April, and to commodity prices for that matter, the situation around that economic feed through, impact on trade, it has kind of settled down, right? And we're getting new tariff agreements signed with major partners around the world. Have markets absorbed this fully, or are we just on pause mode until we get to the next kind of shock factor?
Yeah, well, that's a tricky one, right? My team likes to think of it the following way. The tariffs, we make a distinction between the tariffs and uncertainty around tariff policy. So if we say the US government, for whatever reason, thinks that the rest of the world needs to pay up for the services the US has been providing over the years, whether that's the defense umbrella or the role of the dollar as the global reserve currency or the role of the Treasury as the world's risk-free asset. If the US government thinks the rest of the world's going to pay up, and they assign tariffs to everyone based on some hopefully reasonable formula, and that's it, kind of one and done. Markets will adjust to that, prices will adjust to that. It's easier for us, relatively easy for us, to kind of forecast that. We look at the trade of each country with the US, and we put in the elasticities or the sensitivities or whatever. That's kind of doable. The problem since all of this started earlier this year is really around policy uncertainty or policy unpredictability. So I like to point to a data series that's produced by the Fed, which sounds rather boring, and it has been boring for the last 3 or 4 decades. It's called the U.S. Policy Uncertainty Index. And if you think about the traditional role of the U.S., that series doesn't do very much, right? It's a rather boring series. It's trundling along close to zero. It has spiked 3 times in its history, once for the global financial crisis. Policymakers were trying to figure out what to do, biggest shock since the Depression. That was understandable. It spiked again during COVID, first pandemic in a century. Policymakers were trying to figure out what to do, lots of uncertainty. And then it spiked again early this year around tariff policy, and it has remained relatively elevated. And as you noted, Andy, when the tariffs were first announced, the markets kind of went down in a big way. But then, the administration pulled back, and then we got the pause, and then the extended pause, and then the short-lived, very steep trade war with the Chinese was also kind of put on hold and stretched out. So markets are more comfortable. But there's clearly an inverse relationship between new tariff policy announcements and market valuations. The hope is that we can get to a point where the tariffs are pretty much settled. Again, it's relatively easy and mechanical to put them into the model, and if we get the uncertainty off the table, I think that will help. I'm not convinced we're there yet, so we'll have to see how the rest of these trade deals play out. We have a handful of deals, including the one just announced with Japan recently, but there are a lot of trading partners, including Europe, where the final arrangement or configuration hasn't been agreed yet.
The big trading partner, China, is that relationship in kind of on hold? Can it be repaired, or where do you see that going?
Well, two things. One, when the U.S. escalated tariffs against China, China had kind of the textbook tit-for-tat response, right? China was matching the U.S. very quickly, one for one. The tariffs on both sides got above 100%. At some point, they become almost meaningless because trade is going to stop. And then we had the climb down, and we had the extension, and then we had the rare earths deal on the Chinese side. I think it was airplane engines on the U.S. side, and we're kind of kicking the can down the road for 6 months. I was in China a month ago at the China Davos meetings. That's the China version of the Switzerland Davos. It takes place every June. I was surprised how relatively optimistic and calm the Chinese officials were and business leaders were about the tariff situation. So China's been kind of gradually making itself less vulnerable to the U.S. and trade more generally. So U.S. Exports to the U.S. are less than 2% of China's GDP. China and the U.S., as we just discussed, had this very brief trade war that's calmed down. China's continuing to produce world-beating electric vehicles and batteries. They're pushing trade into the global south, away from the U.S. and the Europeans, where a lot of tension is. So China seems to be relatively comfortable with what's going on. Obviously, as the two biggest economies in the world, we want the U.S. and China to have a stable relationship. But again, we look at the 6-month pause as kind of a Band-Aid. We haven't fixed these fundamental problems around trade imbalances, some of the security issues, tech issues, et cetera.
How do you see the BRICS playing into that imbalance around trade issues, and also, to a certain extent, sort of challenging the US-centric international rules-based system, shall we say, and established institutions of governance, intergovernmental organizations? China is very much at the center of that, with some major commodity producers like Saudi Arabia. The U.S. administration has certainly expressed its probably disdain is too strong a word, but its caution around BRICS. Do you see it sustaining? Is it a key part of U.S. Of Chinese economic policy going forward that's going to be, something that will last for a long time?
Yeah, well, I think the rise of these Chinese-based or Chinese-led institutions is very important. I think, as you know, Andy, I'm a former IMF guy. I spent the first half of my career working at the International Monetary Fund, and the fund, along with the bank and what eventually became the World Trade Organization, these are the Bretton Woods institutions. They were created by the U.S. and its allies after the Second World War. They are U.S.-led. The U.S., at least in the bank and the fund, is by far the biggest shareholder. They have a controlling interest, and China is either the number 2 or number 3 country in terms of its weight and voting power and paid-in capital, but they're well behind the U.S., and these are clearly U.S.-led institutions. They're based in Washington. China's a rising power, and if we look at the BRICS, which you just mentioned, or the Belt Road Initiative, or the Asia Infrastructure Investment Bank, which is based in Beijing, these are Chinese initiatives and China-led institutions, and I think this is part of the global rebalancing. We're still going to have global institutions. Obviously, we would put the United Nations in there as well, but as a rising regional and global power, China clearly sees it in its interest to create some of these new institutions where China has a controlling role. And again, we've got to see how all this fits together. What I like to say in my presentations is the old Washington consensus is gone. That's the free trade, free capital flow, kind of borderless world, where government plays a secondary role. Security issues were kind of secondary. We're not in that world anymore, but I don't think we've reached the new state or the post-Washington consensus kind of steady state. And these institutions and China's role are definitely part of that.
And a key part of that Washington consensus is the dollar, right? And it's certainly come under a lot of scrutiny recently, obviously with the trade tariffs policies and some weakness. I've interestingly been reading Ken Rogoff's book, Our Dollar, Your Problem. And, it goes into a number of scenarios that could tip the dollar over the edge. Of course, the dollar replaced the pound sterling as the global trading currency after World War II. That book is not sort of predicting that any sort of repeat of that is coming anytime soon, but it's certainly there are flashpoints potentially. I mean, where do you see the dollar going the rest of this year? And do you think concern around the dollar is kind of it's not really aimed at the right thing? Is maybe cryptocurrency more of a concern to the dollar than, say, what's happening with tariffs or the Fed?
Yeah, well, the role of the dollar, if you think about it, it's pretty amazing, right? Because the role of the U.S. in the global economy has been shrinking since the end of the Second World War. Japan and Germany recovered. We had the rise of Asia, the rise of China. The U.S.'s global GDP share is 20%, maybe a bit more. And then, Europe and China are roughly the same. But what hasn't changed very much is the role of the U.S. dollar. We are still in a very dollar-centric world. Most of the central banks hold their reserves in dollars. Most trade is denominated in dollars. Contracts are in dollars. And I think that's going to be very difficult to dislodge. We're going to have Ken Rogoff on my academic seminar series later in the year. He came on with his earlier book a few years ago. This time is different. But we think of it not only as the dollar, but it's kind of a pair. It's the U.S. dollar as the world's reserve currency, and it's the U.S. Treasuries as the world's reserve asset. And the depth and breadth and sophistication of the U.S. Treasury market is just unmatched. No other currency even comes close. Europe, as we know, still has fragmented debt markets. They're still waiting for their Hamilton moment. The Chinese like to control the system. They have a large market, but it's relatively undeveloped and unsophisticated. So if you want to do something with foreign exchange and you're a trading country and you're accumulating dollars, you have a lot more things to do with your dollars than you can with your euros or your Chinese yuan. And then the next kind of level of countries, whether that's pound sterling, Canadian dollars, Aussie dollars, Japanese yen, those are just not big enough and deep enough. So it looks like for the time being, we're still in a dollar world. The share has been going down a bit, but I don't think it's in any danger of being displaced anytime soon. You mentioned crypto. If you go into the crypto world and you go to one of the websites and you look at the stable coins or even Bitcoin, Ethereum, some of those, they're all referenced to the US dollar. So the crypto world is even more dollar heavy than what we would call the traditional finance world. So that doesn't mean the dollar gets to rule forever, and it doesn't mean the dollar is the reserve currency forever, but it is very entrenched in the system, and there is no obvious competitor in the near term. So as far as my team is concerned, for our forecasting horizon, we're still in a dollar world for the foreseeable future.
And the U.S. debt doesn't have any impact on that, and this, constantly ballooning fiscal deficit, that doesn't really move the dial on that. In fact, kind of in that logic, it would kind of add to it. It's if we lose, everyone loses.
Well, the fiscal trajectory gets a lot of discussion. Let's remember that net debt is always zero, right? For every debtor, there is a creditor, and if you look at the yields of the U.S. 10-year, they haven't really done very much, even as the debt level has climbed. So there's still a huge bid or huge demand for U.S. Treasuries. That's not enshrined in stone. That can at some future state unravel. I don't think we're anywhere close to that yet. And also, to come back to crypto, we just had some legislation passed on stablecoins in the U.S., the so-called Genius Act. But remember, those credible stablecoins need to be backed by high-quality liquid reserves, and those are going to be U.S. Treasuries for the most part. So as the crypto world gets built out, and stablecoins are kind of the bridge, the fixed exchange rate between the traditional world and the DeFi world, that's another demand or another bid for U.S. Treasuries. So there's some structural factors in the world, or structural tailwinds, that are still supporting the use of the U.S. dollar.
And, ultimately that's underpinning, what I think you could describe as, U.S. exceptionalism in a way that the U.S. economy...
That's part of it for sure, yeah.
Yeah, it continues to, perform incredibly well. The world's biggest companies are U.S. companies. NVIDIA, market cap of $4 trillion, incredible.
Not too shabby, right? So, right.
Yeah. And despite all this policy uncertainty, despite so much geopolitical risk in the world, despite the kind of the tugging at the fibers of globalization, which has definitely benefited the U.S. in the post 1945 world, the U.S. continues to succeed. What's behind that? What's driving that?
Well, I think the policy predictability has been a big thing. There's a first mover advantage, creating this wonderful infrastructure around U.S. Treasuries that's really unmatched, as I mentioned earlier. That helps as well. Scale, obviously, is a big issue. There are only so many countries that have the size and the depth and the complexity and diversity that allow them to be a global economic leader. There is a scenario, by the way, that if Europe embraces some of the reforms from the Draghi Commission and other reports, and Europe becomes more competitive, and they unify their bond market, have their so-called Hamilton moment, where they can issue debt from the center and build out the depth and complexity and breadth of that market, and embrace tech and some of the other things that make the U.S. successful. I realize that's a long list, but if that all happens, the euro could be a potential competitor to the U.S. and the dollar. But right now, again, there's really no rivals to the U.S. in terms of the scale and the breadth and the sophistication and the liquidity and everything else.
Before we move on from the dollar, one of the interesting points pointed out in the Rogoff book is around some of the countries that peg to the US dollar and how that could change over the coming decades. Certainly a story in my experience as a journalist working in the Middle East, going back 20, 25 years was, how long will Gulf states peg their currencies to the US dollar? Of course, they sell their oil in US dollars and they hold vast pools of capital in US dollars through their sovereign wealth funds and various investments overseas. However, as more of these countries now start to diversify and invest heavily in building infrastructure and diversifying their economies faster, like Saudi Arabia, and they have to borrow to do that, the incentive to remain pegged to the dollar may wane. Do you see that as a risk?
Well, remember, we had, if I go back to my IMF days, we had a bunch of countries in Asia that were pegged to the US dollar. That ended up being a problem because, they were a lot of capital inflows into dollar. The exchange rate couldn't adjust to reflect those, and then, Thailand, and then followed by Korea and Indonesia, those pegs kind of blew up. But what happened after those pegs blew up is those central banks started to accumulate even more dollars. So I remember I used to run the IMF office in Korea about 20 years ago, and Korea literally ran out of foreign exchange in 1997-98. That's when they had to come to the IMF for a program. But they spent the next 10 or 20 years accumulating an enormous pile of US dollars to not peg their currency, but to backstop their economy, kind of a self-insurance argument. So we see that across Asia Pacific. Japan has a huge pile, China, all the Southeast Asian countries, the Koreans have it. So anyone who likes to manage their exchange rate and they want a safeguard for turbulence, whether that's capital outflows or something else, they've created big piles of dollars. On the peg to oil, that's a lot more complicated, right? Because oil's denominated in dollars. It kind of makes sense for countries who are big oil exporters to peg to the US dollar. That would all have to unravel. And again, the question is, if you're not going to denominate oil in dollars, you're going to have to denominate it in something else. You know, that could be euros, could be Chinese yuan. I'm not a big fan of these basket currencies. I did spend some time at a bank. Andy, I think when you interviewed me first in 2010, I was working for a bank. I was working for ANZ.
I think so, yes.
In Singapore, but the traders don't like these bundles of currencies, whether they're called SDRs or something else. They immediately want to pull them apart into their constituent elements. So I think it would have to be a peg to something else. But again, there's a lot of kind of first mover advantage and hysteresis in there. A lot of those products are still denominated in dollars. And I think that's more than just pricing oil. It's the whole dollar ecosystem. So for that peg to be kind of reconsidered and reevaluated or abandoned, that's a much larger question, I think, around the global economy and the kind of dollar centricity of the global economy that we discussed earlier.
So we're just past the midpoint of the year. What's your scorecard for the global economy at the moment, 1 to 10? Where are you ranking it?
Let me break it down into what I call the big kids table. So we'll do Europe, the US, and China, okay? We'll give scores on each one of those. Let me start with China. I think China has overperformed. We're always a little bit skeptical of the official growth targets. They come out at 5%, but the Chinese have been able to deliver 5%. They still have structural issues around the property market and some of the overinvestment, but at least on the GDP, kind of the flow data, et cetera, you know, China's doing okay. So I don't know, I want to give them a number. They're higher than 5. I think the Eurozone is interesting in the sense that when interest rates were jacked up 2 years ago by most central banks, we were thinking economies would go into a recession and then, you know, rates would be lowered and then you'd get sort of the classic recovery. And that's essentially what has happened in the Eurozone. Germany had a borderline recession. They are more interest rate sensitive. They're also more sensitive to energy imports. The ECB cut rates, as I mentioned earlier. We think they're done. They're at 2%, and now we sort of see a gradual recovery. So that's been sort of a textbook thing. The US is obviously the tricky one. There is a huge amount of distortion around macro variables because of the tariffs. And if I stick to the narrow macro, I won't talk about immigration and border and things like that. We initially had a soft landing scenario for the US last year, where growth would go from 3-ish, where it has been for the last 2 years, to kind of 2-ish, without a recession or without even an undershoot, which is a growth recession. We've had to abandon that view because of the uncertainty around tariffs. As I mentioned, we don't have a recession, outright recession, but we have a growth recession. We think the US is going to slow to about 1% by the end of the year. The Fed will start to cut rates, and then we'll pick up a bit. But you know, if we get some supply side reforms in the U.S., you know, you're in the world where permitting matters, ease of doing business matters. That's a big thing in the energy and commodity sector. We've got AI and some possible tailwinds around productivity. You know, that's going to drive growth, but you know, the budget that was just passed boosted the deficit, so we're kind of going the wrong way and getting the debt to GDP ratio down. The numbers are getting distorted, as I said, because of trade. The first quarter GDP in the US actually fell. A lot of that was just front-running imports ahead of the tariffs, and looks like the second quarter is going to be about 2.5. We're going to take those two together individually. Analyzing them doesn't make a lot of sense, but the first half of the year, U.S. looks like it was growing a bit faster than 1. Consumption is slowing, discretionary consumption. is slowing. So, report card for the administration, I'm not sure I would put them above a 5, probably below a 5 for the first part of the year. If we get the supply side reform and, we get some, agreement on the tariffs and growth picks up, yeah, but this is kind of a self-induced growth recession that wasn't in the forecast before the change of administration.
Yeah, of course. And I think, if you look back to April when everyone was a bit fearful about where this was heading globally.
Yeah, the recession, we were never, I'll give a shout out here to my chief U.S. economist, Satyam Pandey. We were never in the recession as a baseline camp. I know a lot of economic shops put in a recession as their baseline after the initial April 2nd so-called Liberation Day tariffs were put into place. We always had a growth slowdown. That looks like it's the right view. But again, that wasn't the baseline when we started the year. So if we're doing a scorecard on 2025, I think we have to give marks below average for that one.
Final question, Paul. We're both fanatical cyclists. I think it's a given that Tadej Pogačar is going to win the Tour de France.
Yes.
So, final question is, how many more Tour de France's can he win?
Boy, I think there's two things. There's how many Tour de France's can Tadej win, and the other one is can he get Eddie Merckx's record, which was just broken by Mark Cavendish, I guess, for the Tour wins. It's 35. The guy's amazing to watch. I would encourage everyone who has even a small interest in cycling to go to the Tour de France website and look at just the 8-minute videos that show the summary of the day. These races are 4 or 5 hours long. But the guy's absolutely amazing. He's fearless. After 4 hours of climbing, he's 180 kilometers into the race. He's up out of the saddle, racing to the finish to grab another 2 or 3 seconds from his main rival who's right behind him. And it's just a lot of fun to watch. The guy's always got a smile on his face. And of course, the scenery's gorgeous because they're in France, they're in the Alps, they're in the Pyrenees, they're wherever. But it's great fun to watch. But I think if he stays healthy and avoids the nasty pitfalls of cycling, I think he's got a number of years ahead of him. He's just great to watch. He's great for the sport.
Yeah, I completely agree. Well, I'm going to go on the record and I say I think he can do 6. I think he's going to take Eddie Merckx's and Bernardino's records of 5 Tour de France's.
Yeah, I think that's definite. If he's on track to win, so this would be his 3rd this year, right?
Yeah, that's it. Absolutely.
I think he's got 2 more on the bike. I think he's got at least 2 more on the bike. I agree.
Yeah. Great. Well, Paul, thank you so much. I think we covered so many bases from the U.S. economy through to the U.S. dollar, de-pegging, central bank independence, the trajectory of tariffs and their impact globally, China, and we finished off on a high note with the Tour de France. Doesn't get any better than that. Thanks very much.
Thanks very much, Andy.